Hello. I would like to spend a little bit of time going over a balance sheet with you and actually look at a ratio, and I think that it might make more sense. Um, if you've gotten this far, you may realize that for chapter 13, chapter 14, I posted a video that says chapter 8. That is from the old textbook, but it pretty much covers everything in this chapter except what I'm going over now. And I thought it did it pretty well, so I did not redo that particular video. So let's talk about, this is an income statement, okay? So if somebody told you that they had $3 million in sales, let's think about what we know. At that particular moment, all we know is that they had $3 million in sales. We don't know if they had $5 million in expenses. So just because somebody tells you they have $3 million in sales doesn't tell you anything. So I'm going to go through this. Cost of goods sold is $1 million. So what that means is the material that it took to make whatever you're making. Let's say a shirt, okay? The buttons, the thread, the cloth, everything it took, the actual material. I'm not talking labor, but the materials it took to make that cloth or make that shirt is $1 million. So your gross profit is $2 million. Now, again, if somebody said we had a gross profit of $2 million, what does that tell you? Not much, okay? All it means is you have a gross profit. Gross means before anything comes out. Net means after stuff comes out. So let me just give you a quick example. If you make $10 an hour and you work 40 hours a week, your gross pay is $400. But as we all know, you do not bring home $400. You bring home less than that. And what you bring home is called the net, because all those taxes and everything has to come out of it. So gross profit is before anything comes out other than the cost of goods sold. So we are at $2 million in profit. Now we have to take off some other expenses. Marketing. We had $500,000 in marketing, and we've learned what marketing is: promotions, placement, pricing, all that stuff. You had sales expenses of $200,000. These are the little trinkets and stuff that you give away to make your product known. And then for general and admin. And so this is stuff like labor for the girls in the office or the boys, for the people in the office, the copy machines, the paper that goes in the copy machines, all of your general and administrative expenses. And that's $300,000. So your operating profit is $1 million. So we've gone from sales of $3 million all the way down to operating expenses of $1 million. Again, let me just reiterate, just because you made $3 million, just because you sold $3 million doesn't mean that you made $3 million. So now in our income statement, we're down to an operating profit of $1 million. But we still have other stuff to come out of that. So we have loans. The good thing about loans in a business is that you can deduct the interest off of them before you pay taxes. So we're going to deduct $500,000 in interest. So our pre-tax income, what we have to pay taxes on, is $500,000. So we've gone from sales of $3 million all the way down to income of $500,000. So that $500,000 we got to pay taxes on, income taxes, I'm using 30%, which is pretty close now, and that's $150,000. So your net income, what you actually made on sales of $3 million, is $350,000. So there's a couple of ways to analyze this. So if I were analyzing this and saw that I had sales of $3 million, but I spent $500,000 on marketing, I would say, whoa, wait a minute, that's a pretty large number. That is as much as sales in general and G&A combined. What are your marketing expenses? So that's one way that you can look at this. Another way is to look at interest. How many loans do you have, and what is the interest rate to repay to have $500,000 in interest? So those are kind of sort of the ways that you can look at this and kind of point out things that are good or bad. Cost of goods sold is $1 million. Depends on what you're making as to whether or not that's good or bad. Okay? So your textbook talks about some of these ratios. One of the ones that they talk about is a profitability ratio. And that is net, let me make sure that it is, net profit to net sales. Okay? So we already know our net sales. We've already said that our net sales are $3 million. And our net profit, and I'm going to use income, is $350,000. So let's just get a calculator here. Let me get a calculator. We have 350,000 divided by 3 million. Make sure I got the zeros right. And then let's do percentage. I'm sorry. So that's 1.16%. And your textbook says a grocery store usually has a very low net profit, perhaps below 1%, where a jewelry store might have one that exceeds 10%. So it's not great, but it's not like super, super bad. And so the reason that we use ratios is you could take that 1.16% and look at other industries to see what their percentage is. Because, as I've been trying to explain to you, just having $3 million in sales doesn't tell you anything. It just tells you you have $3 million in sales. So I hope this goes a little ways in understanding an income statement. There's a balance sheet. There's all kinds of financial statements. But this is an introductory to business class, and we're not going to take a deep dive into accounting. That's not the purpose of this course. The purpose of this course is just to give you your basic kind of wet your toe in what accounting means. So if you have any questions, let me know. Thanks.